SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Let's start this SUERF-Baffi Bocconi workshop. I mean, it's a real honor to chair and welcome the panel members, the presenters, and the discussants to this very interesting and topical meeting and workshop on sovereign domestic debt restructuring handled with care. The pandemic has really led to an increase in debt levels across the globe. And if you look at emerging and developing economies, of course, domestic sovereign debt is playing a larger role and is likely to play also a larger role in sovereign debt crisis going forward. So, of course, this discussion from this IMF discussion paper, I think policy paper it's formally called, is very topical for the moment. It was published in December 2021, and we are very happy to have the three authors of this paper here today with us. So there is first Peter Breuer. He is the chief of the Debt Capital Markets Division. That's in the Monetary and Capital Markets Department. I think you normally abbreviate that as MCM. Then second, we have also Ilyina here. She's Assistant Director in the Strategy, Policy and Review Department, I think also known as the SPR Department to those who know the IMF better. And then we have also Hoang Pham, who is the Deputy Unit Chief of the Legal Department. So we have also a lawyer among the group so that we get the economics and legal perspective in this policy paper. But this is not where it stops here today. We also have some excellent discussants. First of all, Carmen Reinhart. I think she is really an established name when it comes to sovereign debt issues and discussions. She's currently the Senior Vice President and Chief Economist of the World Bank Group. Then we also have Yannis Manuelides. He's a partner at Allen and Overy. And then finally, we have with us Roberto Sifon Arevalo. He's the Managing Director, Chief Analytical Officer of the Sovereign and IPF Ratings at S&P Global. So this allows us really to get a global policy, legal, and ratings perspective on this discussion and on this IMF discussion paper. Without further ado, the floor is yours.
Thanks so much to SUERF for hosting this very interesting event, and we're very grateful to the panelists for making themselves available to share their thoughts on this. And then, of course, to all of you, the audience, for participating here today in what we think is an important topic and will be important in the time ahead. This is really the first time that the IMF is speaking at length about sovereign domestic debt restructuring. We take as a starting point a sovereign with an unsustainable debt situation who has chosen to restructure their debt to address that issue. We do not consider alternative strategies to reduce debt, such as through inflation or financial repression. We do analyze that in the empirical section, but in the section that provides a framework of how to think about a domestic debt restructuring, we focus on just that, not on these alternative strategies. So
we don't hear you.
Okay. Not sure how much you missed, but basically we are focusing on whether to include domestic debt in a restructuring. Secondly, on the practical, legal, and procedural issues in the context of a domestic debt restructuring, and how to mitigate the spillovers. So why analyze sovereign domestic debt restructurings now? Well, their likelihood of occurring in the future has increased. Already, domestic debt accounts for nearly half of total public debt in emerging market and developing economies. And that's up from about a third 20 years ago. And as we know, total public debt is very high, and indeed the COVID-19 crisis exacerbated that. It now amounts to about 60% of GDP in EMs and developing economies. and is projected to stay elevated over the medium term, as you can see in the two charts on the right-hand side, where the dotted line indicates the projection. Sovereign financial sector linkages have increased and are expected to remain high, and also the share of emerging market and developing economies at risk of public debt distress is up. And as Anna will explain in just a minute, the change in the structure of that means that with more marketable debt, restructurings of that type of debt are more likely. So why are domestic debt restructurings different? Well, first, let's just think about what is the definition of debt, of domestic debt. The one that we use for the purposes of this paper is public debt governed by domestic law, as opposed to on the basis of residency or currency. However, given the lack of data, we do have to use those latter two concepts in our empirical work that Anna will present in a minute. We should remind the audience that it is the sovereign who decides whether to restructure the debt, and the IMF advises its members to stay current with their obligations. This paper merely provides an economic and legal considerations for those sovereigns who have decided to restructure the domestic debt. Domestic debt restructurings are different from sovereign external debt restructurings in at least 4 different aspects. Domestic institutions tend to be the ones who hold the largest share of domestic debt and hence bear the brunt of financial losses if that debt is restructured. Secondly, the impact of a domestic debt restructuring is exacerbated by the fiscal consolidation and the stress in the financial system that tend to occur at the same time because of the problems that brought the sovereign into distress in the first place. Thirdly, a domestic debt restructuring could help to mitigate the loss of external market access to the extent that it avoids having to restructure external debt. And fourthly, it may actually be easier to conduct because sovereigns enjoy the local law advantage. And Hoang will talk about this more in a minute. So now let's take a look at the experience with domestic debt restructurings in the past. Over to Anna.
Thank you, Peter. So over the past 40 years, sovereigns in emerging and developing economies have resorted to a variety of debt reduction strategies. So in the chart on the left, you can see our sample of debt restructuring episodes that is broken down by types of episodes. And you can see that in some cases, sovereigns achieve the debt relief by stealth, that is by eroding the real value of domestic debt through high inflation or financial repression. Those are shown in gray. In other cases, this was done by explicitly changing contractual terms of debt obligation to the detriment of creditors. Standalone external debt restructurings, shown in blue, and also domestic debt restructurings only, DDRs, shown in yellow in this chart. So the scope of restructuring varied, obviously, as well. Some of the past restructurings included both domestic and external debt, and those are shown in green. But there were also episodes when external debt restructurings occurred in the context of sort of de facto domestic debt restructuring, that is high inflation and financial repression. While external debt restructurings captured many headlines over the past 40 years, domestic debt restructurings have become relatively more frequent over time. And so if you look at the chart on the right, it shows different decades. And as you can see, between 1990 and 2020, there were roughly as many standalone domestic restructurings as standalone external restructurings. These changes likely reflect a number of factors, most notably financial liberalization, including improvements in policy frameworks, such as widespread adoption of inflation targeting and financial deepening in emerging and developing economies. Moreover, increased reliance of emerging market sovereigns on domestic marketable debt likely required more structured approaches to debt restructuring. Next, sovereign debt was typically restructured in response to fiscal pressures. So this was a policy reaction. These pressures were often triggered by different types of shocks, either triggered or exacerbated by different types of shocks, including external shocks, recessions, or financial crisis. In general, what we see, we have a more stylized facts in the paper, but just to highlight a few things, what we see is that greater economic and/or financial stress tend to lead to larger scale debt restructurings. For example, comprehensive restructurings that include both external and domestic debt typically occurred under more stressed conditions than standalone domestic debt or external debt operations. So the chart on the left shows that about half of comprehensive restructurings, shown in green, were either preceded or accompanied by banking crisis. In contrast, this was extremely rare in the case of standalone domestic debt restructurings, shown in yellow. The chart in the middle shows that pre-restructuring real GDP growth rates were on average lower prior to comprehensive restructurings compared to standalone domestic or external debt restructurings. And so, unsurprisingly, the scale of debt restructuring, shown in the chart on the right, which is a share of restructured debt in total public debt, also tended to be larger in comprehensive restructurings than in either domestic only or external only debt restructurings. The complexity of EDR, DDRs was also obviously much higher. And if we compare the duration of the restructuring processes in these various cases, they were shorter in the case of standalone DDRs. So you can see more of those stylized facts in the paper. So next, let's take a look at the post-restructuring macro-financial outcomes, which are typically shaped by both shocks and policy choices, which are hard to disentangle. So given small sample data limitation, it is difficult to say which of the restructuring options would entail smaller economic costs per unit of debt relief, which is what ideally, policymakers would like to know. But our analysis suggests that overall post-restructuring outcomes tend to be worse when both domestic and external financing channels become impaired. So the charts in the slide show the post-restructuring average cumulative changes in three variables: real GDP, the domestic credit to GDP ratio, which is a proxy for domestic financing channel, and the capital flows to GDP ratio, which is a proxy for external financing channel. So there are three takeaways from this. So as you can see in these charts, both output and credit contractions tend to be sharper following comprehensive restructurings. And you can see this in green lines in the left and middle charts. Second, there's little evidence that the external financing channel becomes impaired after standalone domestic debt restructurings. And you can see this in the yellow line in the chart on the right. And third, both domestic and external financing channels are clearly negatively affected during comprehensive restructurings. So these observations also hold when we try to control for different types of shocks. The next question is whether past experiences can help shed some light on the common factors that tend to influence the debt restructuring choices, which is really the main focus of this paper. So in the paper, we explore this through a probate regression analysis in which both unconditional and conditional likelihood of different restructuring choices, DDRs, EDRs, and comprehensive restructurings, is estimated as a function of macro, fiscal, and structural variables. So let me just highlight one thing here, is that we find that structural characteristics, such as the composition of public debt or the depth of the domestic financial system, play an important role in debt restructuring choices. So the chart on the left shows that sovereigns who opted for standalone domestic debt restructurings tended to have a very low share of external public debt held by private creditors. So this means that involving external private creditors would not have provided meaningful debt relief while damaging the external financing channel. So next, also, the chart shows that sovereigns who opted for standalone domestic debt restructurings also tended to have a relatively low bank credit to the economy, which meant that the capacity of the banking system to transmit shocks to the rest of the economy was likely limited. So given these characteristics, it's probably not surprising that overall standalone DDRs have been more common in low-income economies and small states, while comprehensive restructurings involving both domestic and external debt have been more common in emerging markets. So to sum up, past experiences suggest that the decisions on debt restructuring modalities, which will be discussed next, would typically include the following considerations: severity of economic and financial stress, scale of the debt problem, sovereign debt structure and investor base, depth and resilience of the domestic financial system, as well as the importance of external market access for both sovereign and private sector, and potential reputational costs associated with restructuring of debt. Thank you, and over to you, Peter.
Now let's think about how a sovereign can think about whether domestic debt should be included in a sovereign debt restructuring. In the paper, we present a holistic framework that helps with making the decisions which debt to include. The objective here really is to identify the type of restructuring that will restore public debt sustainability while minimizing the disruptions from economic and financial upheaval. So first, in step one, it's important to establish the debt relief target that will help to restore public debt sustainability, both from a solvency and from a liquidity perspective. In the second step, the sovereign then looks at the structure of the debt in order to identify the perimeter, for example, by instrument type, and the categories of creditors holding restructurable debt. And I will return to this in a few minutes. On step three is really sort of the core of the decision-making framework, whether or not to include domestic debt in order to determine the net contribution from each type of debt that is considered to be included. As you know, governments are often called upon to mitigate the impact of a public debt restructuring. For example, in the past, governments have not been able to avoid recapitalizing banks or offering other supports after or during a debt restructuring, and that reduces the net benefit to the sovereign from restructuring their debt. And this table here provides some types of debt that ought to be considered in trying to arrive at what the net benefit would be. After the benefit net of fiscal cost is established, it's important to also consider the wider economic costs of restructuring debt. And these could include macro-financial implications, adverse effects on market access, creditor coordination and holdout risks, or political economy considerations. In the case of foreign creditors holding the debt, there may be additional concerns about capital outflows, macro-financial implications, adverse reputational effects with implications for future market access, spillovers from unresolved debt. There is a whole host of considerations discussed in the paper that matter. We separate out the central bank in step 5 so as to ensure that it can continue with its normal operation with respect to monetary policy, its regulatory function, or upholding the payment system, and ensuring that it is sufficiently capitalized to exercise its role is very important. Then finally, in step 6, with all this information available to the sovereign, it can then decide which categories of debt to restructure in order to minimize the overall costs while also achieving the debt relief target. And so the outcome might be restructuring only domestic debt, restructuring domestic debt in conjunction with external debt, or perhaps only external debt. Coming back to the question of the perimeter, which claims should be considered? There are at least three ways of cutting the debt. First is by type of borrowers. Should only central government debt be restructured, or perhaps does the debt of state-owned enterprises or subnational governments need to be restructured? And they often have their own insolvency frameworks. What type of claims should be included? These can be sliced by currency, marketability, placement type, or securities type. And thirdly, what types of creditors would be affected? And these could be sliced by residency, by relationship with the borrower, institutions, or type of entity. In general, casting the net wide supports participation by lowering the relief sought from each group. So once the sovereign has decided to proceed with the domestic debt restructuring, it needs to have in place a design and execution strategy. The process should be fair and transparent in order to help encourage participation and reduce the likelihood of costly and lengthy litigation. The instruments can be designed to mitigate vulnerabilities both for the borrower and for the creditors, and incentives can be used to enhance participation, both regulatory and other carrots and sticks, as they are called. Very important is that the restructuring is part of a credible reform plan aimed at restoring macroeconomic and financial stability, as well as the conditions for strong growth, in order to get the buy-in from creditors. And often underestimated is the role of communication in a domestic debt restructuring. It's important to explain to the stakeholders the details of the situation and how the sovereign got there in the first place and what it is doing now to get out of distress, and also to understand the situation and constraints of creditors so that the exchange can be designed in a mutually beneficial way. There are also some legal toolkits important in a restructuring. Hoang will tell us about those.
Thank you, Peter. As we all would expect, sovereign borrowers have significant leverage in a domestic debt restructuring process. A sovereign, through its regulatory and supervisory power, can exercise influence over domestic creditors. Furthermore, a sovereign also has local law advantage, which is the sovereign ability to change the term of its domestic debt contracts unilaterally and retroactively. So what are the forms of this advantage? First, a sovereign may pass new law to impose a collective action mechanism retroactively to its outstanding bonds. Under this mechanism, new payment terms would apply to domestic bonds if a supermajority of bondholders agree. This mechanism was adopted in Greece 2012 debt restructuring and Barbados restructuring in 2018. Second, a sovereign may even change the terms of its debt obligations without involving creditors. For example, in 2019, the Argentine government adopted a decree to extend the maturity of its short-term bonds. The use of local law advantage, however, may have potential adverse consequences and therefore should be subject to strict limits. Retroactive measures may face constitutional and international law challenges, as it was the case following Greece restructuring, where there were multiple lengthy litigations on the grounds of breach of property and investment rights. Moreover, retroactive measures tend to undermine trust in contracts and erode investor confidence. Beyond local law advantage, there are another potential legal toolkit to support domestic debt restructuring is to include collective action clauses or CACs in domestic bonds. The IMF has so far focused on promoting CACs in international bonds, given the greater holdout risks. Also, stakeholders were previously showing little interest in the use of domestic CACs. And at present, no country outside the Euro areas, as we understand, include CACs in its domestic bonds. Given the lack of established practice, the cost, benefits, and challenges of including CACs in domestic bonds should be further considered. This would particularly involve consultations with creditors as well as debtor countries, and assessment of the legal and practical implications, such as necessary changes to public debt management law and changes to issuance practice to enhance documentation and disclosure requirements in domestic bonds. Back to you, Peter.
Thank you, Hoang. Now let's take a look at the spillovers from a domestic debt restructuring and what the sovereign can do to mitigate these. First and foremost are the financial stability implications. The risks to financial stability are higher in a domestic debt restructuring, as the financial system is likely to already be in a vulnerable condition, which the restructuring could exacerbate. It could exacerbate directly through its impact on the balance sheet, on the capital of financial institutions, as well as their earnings potential. Now, reducing the haircut, for example, through reprofiling, could attenuate this financial system stress if it is at all feasible. There's also an indirect impact on the financial system that can be damaging, and that can be through the interlinkages with other financial institutions. It can be through the impact on the value of collateral and the margin calls that this might trigger, and wider disruptions to interbank liquidity. There may also be a loss of confidence that prompts a run on deposits or a fire sale of assets. And there could also be capital flight that puts pressure on the exchange rate. So to safeguard financial stability, stress testing is an integral part to assess the impact on the financial system. It helps to inform the crisis management and resolution framework. Early recognition and addressing income losses and recapitalization needs helps to mitigate the impact on the real economy by spreading it over time as opposed to having it all in one instant. It's important that there is an adequate crisis management and bank resolution framework in place. The financial safety net needs to be supported by contingency planning, and it's important to address gaps in early intervention and coordination arrangements. It may also be possible for a financial sector stability fund to help provide liquidity and capital support where appropriate. Temporary capital flow measures in line with the IMF institutional view may be necessary to reduce the risk of disorderly market conditions until macrofinancial policies become effective, and the central bank's balance sheet may need to be strengthened. So, in conclusion, a key consideration for the decision whether to include domestic debt in a sovereign debt restructuring is the net rather than the gross benefit after taking account of fiscal and economic costs. The parameter should be chosen to be wide as is possible in order to support participation. And the process should be fair and transparent and make plenty use of appropriate communication with the relevant stakeholders. It should be part of an economic reform plan, and it may use so-called carrots and sticks to promote participation. It's important to be mindful of creditor preferences within the sustainability objective, of course, and local law advantage should only be considered when all other options have been exhausted. And there is a question as to whether going forward, collective action clauses could be included in domestic debt instruments. To mitigate the impact of a debt restructuring, it's important to safeguard financial stability, for example, through early loss recognition and where appropriate liquidity and potentially solvency support, temporary capital flow measures and other central bank intervention to ensure market functioning may be needed. And finally, tailored policies for the central bank and also non-bank financial institutions may be needed. Thank you so much.
Thanks a lot, Peter, and also to Anna and Hoang for the nice and comprehensive presentation on this issue. I think without further ado, I can immediately pass the floor to Carmen for her reactions to this presentation.
Yeah, thank you, Isabel, and thank you all. And well, let me begin my remarks by saying that I really recommend this paper. I think a paper like this at the IMF is long overdue because it is a very important issue, and it is one that has been understudied for years. And I don't mean understudied in the sort of academic sense. I mean a real life policy issue that I think merits a lot more attention for reasons that have been discussed already and that I will highlight. So I'm going to highlight and remind everyone why this topic and this paper are really important. Then I'm going to go specifically on some suggestions on framework of the paper. I very much like the paper. I like the combination of empirics, conceptual discussion, review the annexes on the country experiences, which I will refer to, are all very cohesive. What I would like to see more is a little more on what I called varieties of domestic debt restructuring, because they're not homogeneous. And so that's my second part of the presentation. I'll be very quick, which is revisiting how domestic was domestic. And then finally, I'll conclude with what I think is a very important agenda, not just for the authors. This is an agenda for myself and for many others that are working in this area, because this area, as I noted, is relatively understudied and I think very important going forward. So what this shows here is this is just central government, and this database was compiled by Diego Barrot, who is working on this issue, and it's very it's much bigger than the Reinhart and Rogoff sample that considered 66 countries. This gets into a lot of the low-income countries, and there are 2 points to be taken from this chart. And this is, I made this point in my paper, The Forgotten History of Domestic Debt. Domestic debt is not new. Because remember, before, in the era of Bretton Woods, when there were a lot of capital controls, external financing in the modern sense, cross-border movements of capital, governments borrowing from commercial banks abroad or issuing bonds abroad, that was unheard of. So there was a domestic debt market, but we didn't know much about it like we do we comparatively know much more today, which is also, I think, an important message for those working in this area, because I think we will, as we dig deeper, we will find even more episodes of domestic debt restructuring that were more opaque or off the radar screen in the earlier era. But I think what this chart helps to highlight, and the next one will highlight even more importantly, is that on the whole, after, you know, after a period in which domestic debt as a share, this is as a share of total debt, became less important because of, you know, for a variety of reasons, and I'll just mention one. Later, the pendulum swung to external debt. The pendulum is once again swinging back to domestic debt. Next slide, please. And I think this highlights why. Now here it's domestic central government debt as a percent of GDP. And you can see that there's really what I call a two-step ratchet. And it precedes COVID. It's not just about COVID. Many of the low and middle income countries that are here in the African sample and the Latin American sample, which it really encompasses pretty much all the countries in the region, almost, are commodity producers. So the first ratchet up in debt in the recent period occurs not as a result of COVID, but as a result of the crashing commodity prices between 2012 and 2015. You see this in this chart. COVID enters, and now we have a second ratchet up. This is just domestic debt. Importantly, in the previous chart, I had shown domestic debt in a scale of 0 to 100 to highlight that, you know, of course, external debt is still of great importance. I would note that the topic we're discussing, which is domestic debt restructuring, you know, very prominent economists like Paul Krugman actually deny that this could happen, right? I mean, the whole idea is if you have domestic currency debt, you never need to restructure, you can inflate it away. I've argued, of course, for years that he's missing a great many points, but that's a separate discussion. So I'd like to, on that issue, on that note, because in many of his remarks and others, the implicit assumption is that all domestic debt is in domestic currency, which is not always the case. If we could move to the next slide, I think this moves importantly to defining domestic debt is really important, but it is not trivial. In the old days, in the historical work that I've done on this issue, it was much easier because domestic law debt, which is the focus of the largest chunk of the paper, although the empirical paper deals with the reality that not everybody's defining domestic and external in the same way. An issue that I will address imminently. So, you know, domestic law used to be associated with only domestic currency debt and held entirely by domestic creditors. So this is the pure, what I call the pure analog of the external debt that we have studied a lot, and the IMF has studied a lot. External debt in foreign law, you know, in international law, usually in a hard currency, and held mostly by whether official or private external creditors. Now, what I think gets really interested in complicating, and here I would like to pick on the authors to push them more in sorting out these varieties, is the modern version, in which you have varieties of domestic and external. You have, you know, debt that's in domestic law, but some of it is in foreign currency, like Uruguay. Some of the domestic law and domestic currency is held by non-residents. Big example, of course, Brazil. And of course, it doesn't mean that some of the domestic residents are also, especially in dollarized economies or semi-dollarized economies, are also holding domestic debt in a hard currency. So there's the hybrid problem. And the hybrid problem, if we could go to the next phase, please, is this is meant to be, and this is really my last substantive slide before just the road ahead. I think I would like to, push the authors to think more especially when we're comparing the country experiences, where the lion's share of the restructuring is in this chart. My gut tells me that much of it, like the historical episodes, is still in that little piece, that area called 1, which is domestic currency, domestic law, domestic residence. But there's a hybrid, and this began with the peso bonos, really. I mean, the modern era of this domestic debt, and the peso bonos, the notorious, they never defaulted, but the peso bonos in the mid-1990s were really domestic law, but primarily held by non-residents and linked to the dollar. So they really began this world that we live in of hybrid debt restructurings. And I'm sure we will hear more about the Greek debt restructuring, but if you look at the Greek debt restructuring, certainly, it's importantly about, domestic law, domestic residence, domestic currency, but a huge chunk was domestic law, domestic currency, but foreign residents. And here, domestic currency meaning, of course, is facilitated by the Eurozone. But they also had a domestic debt restructuring that affected creditors outside the Eurozone. And this is, I know this sounds like I'm going off in a tangent, but the bottom line is, once you start really thinking about calculating losses, creditor losses and haircuts and comparing them, this scheme here matters a great deal. Because for domestic residents, apart from the de jure haircuts, you're going to get, not always, but quite often, de facto haircuts through financial repression and through inflation. For foreign creditors who are holding domestic law debt that is also domestic currency debt, there's also another part to the haircut, which is not important in the literature on external debt, which focuses on dollar or hard currency denominated debt, and that is losses from currency crashes. So where we are in this scheme importantly affects how we look at haircuts. The last slide, the very last slide, please. So this is just the road ahead. I think we have important data gaps because while we'd like to conceptually think in very clean terms of, well, we're focused, and I did too, focus on domestic law dimension, the data provided by governments is often a hybrid. Some are reporting by law, some are reporting by currency, some are reporting by residency, and the residency dimension is particularly impactful in when you look at CFA franc zone for debt sustainability exercises. It's often the case that domestic currency, domestic debt is often held by the central bank in the zone and not by domestic residents, and it's not at all clear that different countries within the CFA zone are defining domestic the same way. This is very clear from the debt sustainability exercises. Another important data gap is lack of data on arrears, domestic arrears. There's the debt reporting system of the World Bank has extensive time series, you know, from 1970 to the present on external arrears. Again, we know so much more about external debt. This is a black hole that we often learn about at the last minute during a crisis on arrears. Then there's the issue of hidden de jure domestic debt restructurings. I already spoke to this. In the earlier era, I think we have a lot of these, and we may still have some of opaque regulatory changes. For example, pension funds required to hold exclusively government domestic debt is a way, it's a way of enhancing the financial repression tax. You require these institutions to hold domestic debt where the value of the debt is eroded through financial repression or inflation. Quantifying creditor losses is, I think this is where that scheme that I presented earlier is important, because we really do have to bring together the dimension of de jure with de facto haircuts. The work by Josephine Meyer, a former student of mine and co-author, is really pioneering in this regard, trying to systematically also look at haircuts on domestic debt. And I think we can also, and I'll conclude here, you know, I heard very, you know, with great deal of interest, you know, when in the presentation, the damage done by the potential damage of debt restructuring, domestic debt restructuring. And I would add to that, that this is from my work with Sprancia on not just, you know, on the de facto liquidation of debt through inflation and financial repression, that a big potential cost of not restructuring de jure, but doing it de facto through inflation, is that it kills the domestic debt market, which is what happened in many chronic high inflation countries, that the domestic debt market, and with it, the domestic financial sector and the domestic capital market shrank significantly over time. So that's another risk over time. And, you know, why you might prefer doing it de jure than going the de facto route. Let me stop here.
Thanks a lot, Carmen, for this very interesting discussion, and also pointing out to you know, those elements in the framework where, you know, more information and data is still needed, and it will be good that we get this information before such a problem becomes big, and not like with the external debt where, you know, this information becomes available because the problem was so big and then people start collecting the information. I mean, before passing to the next discussion, I would like the authors maybe a chance to quickly react if they want to do so. I see Anna has her finger lifted, so I assume that this is when you want to react. So please go ahead, Anna.
Yes, thank you very much, Isabel, and thank you very much, Carmen, for your kind words. And you really highlighted the issues that we've been struggling with. So I'll just very briefly make a few points. So on the notion of domestic debt, indeed, domestic debt can be defined based on the jurisdiction of issuance, on the residency of creditors, and on the currency of denomination of debt. And for the purposes of the paper, we were particularly interested in the local law debt, but most of the historical data are either a resident by residency or by currency of denomination, and that is a big problem, of course. For a limited number of countries for which debt data are available based on all three concepts. So what we can say is that the overlap is still significant, right? So there's the debt is often issued under local law in domestic currency and held by residents. However, especially in emerging market countries, right, the trend over the last 10, 15 years has been an increasing participation of foreign investors in the domestic local currency bond markets. And so that goes to the point that you made in this chart, that it introduces another degree of complexity, including in the computation of de facto creditor losses and assessing the trade-offs. So this is indeed the case. So on debt restructuring episodes, I think it's also very important to note that compared to external debt restructurings, domestic debt restructurings are much more heterogeneous in terms of instruments, types of creditors, and approaches that are used to reducing the real burden of domestic debt. And also the line between overt and covert debt restructuring is very fuzzy, indeed. So we focus on episodes where the terms of contracts were explicitly changed to the detriment of creditors. But of course, this notion can be expanded to include other ways of achieving debt relief, like retroactive use of withholding taxes, regulatory measures, running arrears with domestic suppliers for extended periods of time, and so on and so forth. And that, of course, then changes the calculus, right? And the sort of the understanding of the trade-offs. On creditor losses, again, this is definitely the area where we need to do more digging and understand this better. But looking mainly at recent episodes of restructuring of domestic marketable debt, we find that coupon reductions and maturity extensions were more common than face value haircuts on domestic debt. And if we look at creditor losses in net present value terms, then on average, at least for those recent episodes, they were lower for standalone domestic debt restructuring than for comprehensive restructurings or external ones. However, once we increase the notion of debt restructuring episodes, with including arrears and all sorts of other things, this may change, right? And so that's, again, something that we need to look closely at. And finally, on the use of inflation, financial repression as a way of, addressing domestic debt problem. I mean, over the last few decades, countries really advanced in terms of making their policy frameworks very robust, including widespread adoption of inflation targeting. So, using that tool, in addition to, wrecking your financial system, as Carmen noted, this would amount to dismantling your policy framework as well, right? And, eroding credibility of the central bank and so on. And that's why, so on balance, we decided that, more structured, transparent way of dealing with domestic debt problem that we focused on in the paper is probably more plausible way of addressing the debt burden when sovereign finds himself or in an unsustainable debt situation. So let me stop here, and thank you again. Thank you so much for your comments.
Thanks a lot, Anna. Being mindful of the time, I suggest we move to the second discussant, and this is Yannis Manuelides. I suspect he may also bring in some experiences from the Greek debt restructuring in his presentation, given his past work, but I'll leave it to Yannis to give us some insights in his view on this, on the presentation and the work from the IMF.
Thank you very much. I hope you can hear me and see my slides. So let me just start by saying thank you again for having me. Just to explain, as I said, I'm a lawyer. I'm not an economist, or I'm not a Hebrew prophet. I don't know what will happen in the future. But I also want to join what Carmen said. This, I think, is a fantastic paper, and it's hugely important. I mean, just to put it very simply, if the domestic economy fails, nobody is going to get paid, and we'll have misery throughout. So, understanding exactly how domestic restructuring happens is very important. Because also, more importantly, the balance sheets of all the related actors are kind of intermeshed, and it is important to look at that. But for me, as a lawyer, and for this particular topic, but also in respect of some of the other things that you've just said, it helps to elucidate, this paper helps to elucidate concepts and the roles of actors, and analyzes the interconnectedness, and also kind of overall, I can say, normalizes restructuring narratives, and helps in an overall better conceptual framework, and through that, I hope, even a consensual framework for resolution. And I think will help us develop more specific tools, and some of them will be statutory, some of them will be contractual. I don't have a particular hang up on that, but I think it will help us on that. And why is it so? It's important, and it's timely because of the of a very important point was made in the World Development Report of the World Bank that was issued sort of last week, that with the pandemic, this interconnectedness has become even more opaque because of the unprecedented measures, and therefore we need to understand exactly what's happening domestically in order to move forward. Okay, so but that's the big sort of macro things, and as I said, I'm not an economist, I'm a lawyer, and so I want to focus on the local law advantage, and what is it? Are there limits to it? And there is a very interesting question raised in the paper and earlier in the presentation, whether we can legislate in advance to eliminate its use. So what are the tools that we have for sovereign debt restructuring, domestic sovereign debt restructuring? We have obviously the non-legal ones that were already discussed. I will not, not the expert, but we have the legal ones. And on the tools, we have, I'll just distinguish between existing tools. I mean, rules that we may already have in our legislative sort of kit, and ex post after the event for the rest of us. I know the fund likes to speak in Latin, uses ex ante and ex post, but for the rest of us, for the others, I'll just say after the event. So the local law advantage is one of these after the event. It's the ultimate after the event kit. So what do we mean by that? So it is the interference with contractual property rights, as I said, after the event. And why is this possible? It's possible because the sovereign is the maker of the laws. It is, in fact, in some sort of grand way above the laws and can create always new ones. And so it's completely within its power to do that. Completely, well, there's some limitations, but it's basically within its power to do that. And very importantly, when these laws are created, they will be recognized in creditor jurisdictions, subject to some exceptions about treaties, but generally they will be recognized. And so that is very different from external laws, which insulate the creditor rights from any such interference of the debt of sovereign. So beyond the constraints, and I'll discuss the constraints later, this thing is problematic because it is after the event, and it offends existing rights and what our sort of sense of rule of law more widely. And because it allows the sovereign to make winners and losers once the sovereign has seen where everything sort of stands. Yet it has been in all major cases accepted. I'm not saying it has not been litigated, but it has been accepted. There has been some sort of a subsequent credibility and even legitimacy. So that's what I want to kind of discuss in more detail. So let's look at other domestic law tools. We have tax, obviously, but tax, although it's a general power of taxation, rests with the state. Any new taxes are almost like sort of local law advantage. I can impose a new tax, and you basically have to accept it. And yes, it has been used, but I don't want to kind of spend more time on this. It's I think it's very important in the toolkit. I think it's important to determine how we could apply it so we work going forward. But I think some of the same principles that I'm going to discuss now should apply in that examination of future taxes. I mentioned here the French insolvency legislation because when I remember going to France, and I discovered that they had a very interesting rule, but it allowed the judge that if determined that the debtor was in a desperate situation, the judge could basically take the debt contract and do whatever the judge liked with it. I mean, really anything they liked. And yet, when I looked for jurisprudence, it was very hard to find any. And it was clear that it was very difficult for the judges, notwithstanding the theoretical power they had to do just anything they liked. They found it in practice very difficult, except obviously in really very, very extreme situations to completely withdraw the contract. So why do I mention this as an example? Because I want to say that even if you have in your existing domestic tools something which gives courts wide discretion, then even that will not necessarily be applied if its application is not itself subject to some sort of rules and legitimacy. So even these rules have to be applied in a manner which is consistent with what we generally would think rule of law and are tested by their application in the circumstances and by their consequences. And concepts that we use, such as fairness, legitimate expectations, burden sharing, property exemptions, etc., they all survive if and only if their application is ultimately accepted as legitimacy and credibility. And that, we just heard from Anna talking about the preservation of the legitimacy and credibility of central banks. And in a way, law is another institution of this sort that the sovereign has to preserve. Otherwise, things will really go very bad. Now, what happened with the local law advantage in Greece and the Eurozone? It's actually very delicate, and you need to look at the details because there was great care taken to preserve this kind of fairness that I talked, to preserve, some key core principles of rule of law. So the bondholders were actually asked, do you want the state to legislate to introduce to retrofit tax? And in the same vote, they would say yes, and if they said yes, they were asked also to accept the exchange. So and it's also important to know that a lot of work was done to find out whether this sort of thing had been done elsewhere, and very happily that was done in Germany for domestic corporate bonds. So it was not completely unheard of, and also it was a very good example because, of course, at the time you had to convince Germany to do anything major of this sort. What were the hurdles? As I said, local law advantage, always has hurdles, and it's of course the Constitution. Does the Constitution impose any limitations? And you have all sorts of extremes, from the very flat Constitution we have in the United Kingdom, where Parliament can basically do whatever it pleases, pretty much, to constitutions that are severely constrained by entrenched rights of all sorts. And you all then have international obligations through treaties, bilateral investment treaties, more importantly. And in the case of Europe and Greece, European Convention of Human Rights that entrenches property rights. I mentioned there also that when you do this, there are other restrictions that are more practical restrictions. You obviously need to do your diligence on what this change of law will do to your other contractual obligations. So Greece did that. Greece retrofitted the tax, and it was actually pursued everywhere. It was pursued in the Greek courts under the Constitution, was pursued in the European Convention of Human Rights and in international arbitrations, and it won everywhere. But the most important decision, and which I think is also relevant to the debate going forward for the topic that we're discussing, is the Mamatas case, a case which was reported in French. And I think that has unfortunately limited its sort of, the commentary because unfortunately not everybody speaks French nowadays. So, so the key question is, can we ever get to, and it's a question the paper brings up, can we ever get to having always rules in advance, ex ante, as you guys say at the fund, like tax, or is it always going to be after the event, ex post, local law advantage? And I just want to bring this aspect. I know work has been done to overcome this obstacle, but I just want to say, and I've written it in a paper for people who want to see exactly what I've argued. But basically the Eurozone today, thanks to this quantitative easing, and thanks to also the restrictions on the European Central Bank for having to vote no in any sovereign debt restructuring of a Eurozone member, this makes it very easy for the Eurozone CACs to fail, because the ECB, with a very, very large holding coming almost close, in some cases now with the pandemic possibly exceeding the threshold for blocking the restructuring, makes it easy for a holdout creditor to come in, buy a little bit more, get over the threshold and block the whole thing. And the two-limb CACs can, because of the two-limb caps that the Eurozone has. And so it's very clear that unless we reform the Eurozone CACs, which we're to do, but before we do it, it may not be possible to basically use the CACs. And if we don't use the CACs, well, what's left? What's left is the local law advantage. It has to be something else, because it can't be that just because of this particular difficulty, we will accept to do nothing. And what is the guidance that we can have from the Mamatas case on the local law advantage? And I think that's why I think it's such an important case. So in Mamatas, the applicants, the people who complained to the European Court of Human Rights were investors who basically said, we don't like this retrofit, it says expropriated us, and etc. And the European Court of Human Rights said, yeah, you're right. This thing actually did violate your property rights. But then it considered whether in the circumstances it was appropriate. And because it pursued a public interest aim and preserving economic stability, restructuring the national debt at a time when the consequences for Greece would have been really perilous, and because the particular applicants had not been specially discriminated, there was no special or excessive burden just on them, because it was fairly spread, and because in any event the reduced solvency of the state meant that nobody would be able to be paid in full. So because of that, the collective action clauses, the court said, and the restructuring of the public debt was an appropriate and necessary means of reducing the public debt. Now, here in this slide, I've quoted the one section from the court decision, which is in French, which I think is actually the most interesting because it has a certain ambiguity. So would the court today decide the same thing, given that Eurocacs are prevalent? Well, the middle thing that's highlighted in bold, it basically said that the court said, well, in any event, we know that everybody's introducing these CACs, and therefore the Greece did not do anything terribly unusual or so kind of surprising. So that suggests that today the court would say, well, you had the CACs, why didn't you use them? At the same time, the last sentence basically says you need effectively to find a solution which supports collective action in a sort of wider sense, but something that can actually deliver a solution. Because if you cannot and you have a failure, then you won't get anywhere. And if you manage to find such a solution that achieves that and achieves all the previous things that the court mentioned, then I think the court would accept it. But I think that this decision and discussing this decision will help determine exactly where we are. And I want to finish with this, that for me, local advantage is forever. We won't be able to eliminate it. As I said, even for existing laws that give wide discretion, when they come to be applied, they have to be applied in a particularly constrained way, because ultimately the sovereign wants. As the sovereign is not interested in that, but I always assume the sovereign is interested in its credibility and legitimacy in attracting, again, investors, in getting its citizens to stay at home and not emigrate or send their savings elsewhere. So for all of these reasons, we will have it, but it will always be bound. And as I said earlier, this applies to CACs, and we need to keep on using these concepts of fairness, legitimate expectations, etc., They will all survive, and we need to discuss them and see how they were applied in particular context, and that alone will enrich a lot the overall discussion we have. And this paper, I think, opens the way for that, and I'm really, really very happy you people produce it. It's fantastic work. Thank you very much.
Thank you very much, Yannis, for this rich presentation and giving the lawyer perspective on this, and also the experiences from the Greek debt restructuring. Being a bit mindful of the time, I suggest maybe we move immediately to Roberto's discussion as well, and then we have some time for discussions and also leave some room, at least from the audience, to ask any questions. So on that, I just remind everybody to post questions in the chat if they may have any. But Roberto, I pass the floor to you.
Okay, thank you. Can you hear me well? All right, so well, I'm going to echo my colleagues on praising the folks at the IMF for putting this together. As you highlighted, this is not new, and Carmen highlighted as well. The domestic debt restructuring has been around for a long time. So this was definitely way overdue, and it's a great thing. You're doing this. I'm sure you'll have future revisions of this, like you know, just by listening to some of the comments of the previous speakers. I think we have already a fair amount of ammunition to go in. I'll go real quick also, because I know we're close to the end, and just make a couple of comments. You know, from the perspective of a rating agency, and having been through some of those, might not be so specific on the architecture of the paper, but yes, on some of the topics you discuss there, and how we have seen them working in real life and practical examples. So the first comment is, you know, one of the key and most positive elements in emerging markets, particularly those that achieve investment grade over the last couple of decades, has been the developing of the local market. You know, you don't need to go over the reduction of the risk of the original sin and all these issues that having a local market gave a lot of these economies. And again, many, particularly in Latin America, quite a few that achieve investment grade, you know, since the beginning of the 2000s. I think in big part has been because of a deepening of the local market. The flip side of that positive was that now you had to deal with, I think it was a perfect diagram, Carmen, the one you had, where you had to try to figure it out, all the different components, and how complex that is for a market that is not sophisticated to begin with, right? So if you had to think about the sophistication of the local market architecture that was, you know, just starting, it's kind of a almost unfair situation in which you're not that sophisticated to deal with it, and you had to deal with a very complex set of different players in the market. So that started to putting a lot of you know, different hurdles on this topic. We ourselves actually find that whereas, as I said, having this local market really propel and reduce the vulnerability of having always to rely on external financing, after those grew to a certain level, it opened another vulnerability. And now you have this massive amount of non-resident holders that now add an external threat to the sustainability of your debt, because those, in times of stress, those are the first one to leave, right? And they don't want to leave with pesos or, you know, or liras or what have you. They want dollars back. So you have an additional pressure on the exchange rate just when you don't need it, right? So and actually, just to bring it to today's reality, if you see why most emerging market has been hiking interest rates before any of the developed market, a lot has to do because of that, because non-residents are leaving. And they're feeling the pressure on exchange rate, and they're feeling the pressure on keep on being attractive to reduce that factor. So I think that has been a key thing that has grown and is becoming a lot more prominent. That's why I think one of your findings there in the article, which is that we're likely to see more and more and more of this domestic debt restructuring, is spot on. I think this is, if you want to keep the main rationale or the main goal that a debt restructuring should have, which is put debt in a sustainable path. Just by definition, if this percentage grows as a percentage of the total, you had to include it. How do we look at this specifically? And I heard a lot of the discussion on domestic versus foreign versus how do you actually define that? We have, as you know, our ratings specifically talk about the currency of the debt, right? So we have local currency debt and foreign currency debt. Now, that doesn't necessarily mean that all local currency debt is looked at domestic. Most of, I would say the majority is, but definitely not all foreign currency debt is looked as external. Some of that is domestic as well. What defines whether it's external or domestic debt for us is the residence of the holder, precisely for the topic that I just discussed before. It's very important for us to understand the exposure that a sovereign has to that sudden exit of non-resident holders of your debt. Over the last few years, as we recalibrate our criteria, one of the changes we made, and again, I think this is also lined up with this theory, goes against the MMT theory, and I think Carmen was mentioning Krugman's comments on that. We used to have 2 to 3 notches differential between the local currency rating and the foreign currency rating, highlighting the fact that every sovereign can print their own currency, et cetera, et cetera, et cetera, right? Now that we have collapsed that significantly, we now only have 1 notch of difference between local and foreign, partly reflecting this new reality, right? I mean, you couldn't really think that you're going to have this difference if you think that domestic debt is so large. And today, we only have 15 sovereigns globally out of 137 that we rate, where we have 1 notch differential on that foreign to local currency. And not surprisingly, those are sovereigns, like Chile, Colombia, Mexico, Thailand, where you do see a domestic market that is pretty strong, and more importantly, stable. And I think that's, you have those 2 components. There are others that have strong domestic markets; they're less stable, and it's harder to see that there is that big of a difference. Now, a couple of other comments on some of the points that I thought that were interesting. The paper says that domestic debt exchange are quite different from external debt exchange, and I think in emerging markets that's changing quite a bit. I think they're looking a lot more alike, precisely for the same topic that I was discussing before, which is the interconnection that you have today. You have local investors buying sovereign bonds in the cross-border market. You have many domestic banks that buy sovereign bonds of their own country when they're issued abroad, and vice versa. You have external institutions buying domestically. So when you go into dealing with a domestic debt exchange, it is no longer that you only deal with, you can sit down in an office and bring the 15, 20 banks of your country, talk to them, a couple of pension funds, and you figure it out. You had to include a much broader set of players to the domestic exchange than than ever before. If you wanted to be successful, that is, right? I mean, of course, you could go down the path of what I think some alluded before on just being a little bit harsher. So I think that's a point. I think I understand they're different, but I think in practice they're a lot less different, and most likely they're going to go to be even less different as we keep on progressing. The other topic is this concept, and I've heard it a lot during the conversations around the DSSI of, if I only do a domestic exchange, I'm okay with my access to external financing. I think that is missing the point a little bit. I mean, I think it's not like if you're sitting in London, you don't get news of what's happening in Bogota anymore. I mean, I think people know exactly what's happening in a sovereign today everywhere. And if you are in a situation in which you had to restructure your domestic debt, it's probably because you're in a pretty dire situation to begin with. So, your access to external financing, it's already, it already assesses that. In other words, if you want, an international investor to lend you money, it's not like they're not going to know that you're in that situation. And if you only restructure the domestic part, you're okay. The only point, and I've seen cases like, for example, in Jamaica, where there was this notion that why hurt that when it's so little and it doesn't really change anything. That it's it's an iffy argument that only applies to a handful of cases, especially very small economies. It didn't apply to Jamaica, by the way, but it applied to a few. It applied to a couple of others. So bottom line is, I think the benefit of just doing domestic, that one might think you get on keeping your external access, I don't think is that strong. And honestly, particularly in frontier and emerging market, investors in those markets, I've come to learn, are a very forgiving group of individuals, right? I mean, so if you if you do a restructuring and you come up with a good offer right after, they'll all jump on it. I mean, the yield drives a lot of the decision making around this. So I think it's overstated, the fact that you will lose access. It will take you a lot to come back. I think, we've seen plenty of examples. I still remember Bahamas 2000, and I think it was 2011 or 12 at the IDB meetings. Argentina was just 2004, just when Macri was coming to power, and people were asking, Argentina was still in default, and investors were asking when was going to be investment grade. Now we know the story. Fast forward a few years, so I don't think access to is that big of a deal there. I do think that the use of the local law advantage might have even a harsher effect on foreign investors and the access to external market that these other part, that whether you did an external or a domestic, because I think there are very clear examples where you could use the local law advantage in a way in which you make the restructuring better and ultimately the proposal easier to execute, and I think the outcome better. Or you could use it the opposite side, like I think some of the examples were done, in which whether you did only an external or not, the impact on the external market is the same, right? I mean, people will stay away from you until things are clear. I think some of the examples were very good. I had two last points. One is there is a lot of discussions around, and the paper does a great job of talking about the mitigation of financial risk, financial stability around all this. I think that's a point that I've always observed with surprise sometimes, the multilateral community being more absent than one would have think they should have been, right? So when you have a small economy, and I remember this was the case of Jamaica, for example, a small economy that really has the majority of their debt is in the hands of the banking system, and you say, okay, well, the message was, well, we can't do this because if we do this, we hurt the banking system. And so everybody understood the diagnosis. And you would expect that in an economy that small, you would have seen a stronger support from the multilateral community for that precisely. In other words, like, I'll help you to shore up that part of the issue because you don't have the resources clear where you are. And I think that providing the firepower to a sovereign at that particular point to do that, so it allows the sovereign to do the right thing. Let me put it that way. So you can kind of provide support. I think it's a little bit missing. I understand why a little bit missing, but you do a great job at describing how important that is. So I think it's great to take that back home and maybe distribute it among other parts of the fund and see what they think about that. But I think it's something to elaborate. And the last point, I mean, just to conclude, is whether it's domestic or external or both, usually politics get in the way of all this. You can't extrapolate. I mean, you have a group. I always face this situation. You sit down with a group of technocrats and they lay it out perfect. I mean, this is step 1, 2, 3, and then then the couple of politicians come in the room and discussion goes 180 degrees on the opposite direction. And why, the paper does a great job at explaining that the main driver for the solution and the option you take or you want to take should be the overall improvement of long-term debt sustainability, which is very logical. However, the experience shows that many see these more as a okay, I can do this. I heard this group of investors that don't vote for me or don't do whatever. They're easier to go against in exchange of or in replacement of reforms. And I think using debt exchange and thinking that the debt exchange and the relief that it gives you replace the need of reform to address why you had to do debt exchange to begin with has been repeated over and over again. And I think there is two clear examples that I will point: Argentina and Uruguay. They both kind of defaulted, big defaults that are on the same time. Argentina was 2001, Uruguay was 2003. As a matter of fact, Uruguay fixed it quicker. I mean, the Uruguay cured the default in 2003 itself. Argentina took until 2005. Now, Uruguay did embark itself in a series of reform. I mean, did they do everything one would have said that they needed to do way back then? Maybe not. But they didn't move away, and they didn't just use the restructuring. Okay, this is all we're going to do. We're going to continue business as usual, with this kind of extra time we just gained. Whereas in the case of Argentina, that was pretty much all it happened. And as a result, Argentina defaulted several times over, including in 2020, the last time, and is rated CCC, and Uruguay is in investment grade and have not defaulted since. And if you look at where Brazil is today and where Argentina is today, the fact to think about that you have Argentina CCC, Brazil in BB- category, and Uruguay is in investment grade. If I would have told anybody in the 1990s that was going to be the case, nobody would have taken that. But I think it highlights how important it is to follow through a debt exchange with the reforms that you needed to avoid being there again. Yeah, I'll stop there because I know we're already 3 minutes over.
Yes, thanks a lot, Roberto, and thanks for the very rich discussion, and also to Yannis again. I mean, we more or less filled up the full time now for the whole session. So I don't know if there's any key points that the presenters would like to raise or still would like to make. I would like not to run too much over time because I'm sure people have other commitments or have other things in their schedules. So Anna or the other presenters, I don't know if you still want to highlight something.
Yeah, so Isabel, I'm aware we're past time. So if I can just make 2 points super quick in response to Yannis and Roberto. Diamonds and the local law advantage are forever. I take your point, but I wonder whether there might not still be a case for a domestic tax in the sense that it introduces an additional hurdle for the sovereign to have to cross in order to use the local law advantage. It is a sort of a commitment device to promise to the world that it will abide by the rule of law, and that might in fact lower the cost of financing, perhaps, just as arguably it has for external debt instruments.
I agree.
That was the first point. And sorry, just the second point on Roberto on the support for by IFIs for financial stability. I would argue that it has been taken into account beyond a paper such as this one. I mean, for example, in Jamaica and in Greece, there were these specially funded financial stability funds to support financial stability that were part of the respective programs with the IMF, and so there was commitment behind supporting financial stability. Let me stop there. Thank you.
Thanks a lot, Peter. Thank again all the presenters, but also the discussants for actually a very rich discussion. And I'm sure this is not the last discussion that we will have on this. It's maybe the first one of many, actually. So thank you very much. And Ernest, I pass the floor to you.
Thank you, Isabel. Thanks to all speakers for your rich insights. This concludes today's webinar. Thank you for participating. Bye-bye and take care.
Thank you so much. Really appreciate it.
Much.
Thank you.
Bye.
Thank you.
Bye.
Thank you. Thank you.
Bye.
Bye.